Happy holidays for everybody. And we are kind of closing out December 2021. I think we kind of felt, we thought we'd be past some of these things, but Mike will be giving us an update on our investments and what is going on in the investment world right now. I'm hoping that this time next year, we'll have a whole different conversation for different reasons, maybe. But I know we always will be looking at our portfolio and how we are structuring it to ensure that we can handle some of these ups and downs and what things are being thrown at us that are out beyond our control. So with that, Mike, I'm going to turn it over to you to start the conversation. And just to make sure people who aren't familiar with who we are, I am Debbie Dabrowski. I'm the CFO with the Vermont Community Foundation. I always forget to introduce myself. And I'm going to turn it over to Mike Miller. He's with Crucial Consulting, has been working with the Vermont Community Foundation since 2001, if my memory serves, and has been guiding us through all the ups and downs over these past X number of years. And I'll turn it over to you, Mike, to take it away.
Great. Thanks, Deb, and good morning, everyone. It's really nice to be with you. Can everyone see this okay?
Yes.
Here, I'm making my screen. Thank you. So great to be with you. And I want to start with maybe making two quick comments. One of which is, and this is something one of the managers in the portfolio said to us a few months ago when the markets were more calm. And he said, he's like, it's obviously really pleasant to have a situation where returns are big and everything is good. But he said, at the end of the day, he said, we really need mayhem if we're going to be really successful and generate really big premium returns. And so I guess be careful what you wish for. We definitely have some mayhem. And I think one of the things we want to talk about today is what does that look like? And a big thing with us on top of mayhem is the incredible differences in what the opportunity sets look like in the markets today. I think there's a lot of things that people are enjoying owning today, and we worry that they won't enjoy them 5, 7, 10 years from now. And so we're very focused on, how do you take a successful portfolio with successful outcomes and continue to make it successful, knowing that the things you need to do to be successful change over time. And I think that's always been a challenging thing for anybody who invests capital of any kind. And so what we're going to talk a little about that today, and the specific points around that will be about inflation rising, which of course we're talking about a lot these days, and also valuations in the markets, which are also quite interesting today in both good and bad ways. So let's start with the results, which have been really quite good. In fact, if you went back a year and a half ago or so, you'll recall that the long-term pool in particular really struggled compared to its benchmark. And that was way more mayhem than anybody wants to ever see. And our lives were all upended and awful things from a personal and tragic perspective that have occurred. And so we obviously don't ever want to go back there again if we could avoid that. But the mayhem, unfortunately, at the time did create opportunities, which the foundation has, as it always has done for the last 20 years, been quite effective at capturing. So these are numbers through September, where you see the portfolio. This is the long-term pool at the top, up 10.5% year to date, which is about 3 percentage points above its benchmark. The 1-year number is a really stunning level of outperformance. We don't generally have portfolios that can do that well compared to their benchmark. But again, if you create enough inefficiency and enough short-term thinking in the markets, there are a lot of 10-cent dollars sitting on the street you just basically pick up. And so that's what the foundation essentially did, if you want to oversimplify the strategy a little bit. The only number on this page that we're obviously still a little disappointed with is the 3-year column, where the portfolio has not kept up with its benchmark. I'll remind you of something I said 18 months ago, which the portfolio struggled in really 2018 through most of 19 into early 20, particularly 19 and 20. Particularly because it has a value bias. It's not all value stocks, but it definitely has a value bias. It also has a very globally diversified portfolio. And really what you want to do is just own as much of the US and as much Apple, Amazon, and Tesla as you get your hands on, essentially. That's not our strategy. It's way too risky. And it only works sometimes, doesn't work all the time. And it's just working now. So that's why we're not really worried about it. We are thrilled, though, to see that the returns are still in absolute terms, almost 9% per year over the last 3 years. As you go over the longer periods of time, the 10, 15 years, and also the since 2002, excuse me. So just to reconcile what Deb said a minute ago and this number, we were hired by the foundation in late 2001 portfolio was restructured during the first quarter of 2002, and that's why we start the record on April 1st. That's when the portfolio strategy was in place. That's where that date comes from. And you can see there's a really, really large premium. One of the things I want to highlight for you just in this top section for a moment is how important it was over 5 years, over 10, 15 years, I can speak, and since April 2002, to outperform the benchmark. The benchmark did not keep up with our actual reason to be here, which is to preserve the long-term purchasing power of your funds at the foundation. That's the whole point. It doesn't really matter if we just beat benchmarks. We have to beat that index. And if you look at the shorter periods, like 10 years, it didn't matter. The premium, while obviously welcome, the 9.4 versus the 8.5, was nice to have, is important. I'll show you the impact in a second. But you could have just been in the index and beaten your benchmark of the 7.1, the CPI plus 5. But when you look at 15 years and since 2002, that's not the case. And I think the point I want to leave you with today, one big one, is pay little attention to 10 years when you think about your portfolios. Pay attention to those 15 years and 20-year numbers now, which it's much harder to get to where you need to go. That's the conditions that we're set up for today, unfortunately. So we need to figure out a way to repeat the past, which I think we can do here, as you might guess. The socially responsible pool is right underneath there, and you can see it too has had really strong returns. In fact, stronger returns than the long-term pool over 3 years and 5 years, and the same over 10 years. And this is, by the way, exactly what we'd like to do. We'd like to see the two pools have very competitive returns with one another. They have very different strategies in place, in part because the socially responsible pool, as you guess, is a pool that is focused on ESG factors in a more systematic way than the long-term pool, although I want to give you a bit of a preview. In the next year or so, you will be hearing more and more from us about how these pools are converging philosophically, in the sense that the long-term pool actually does not ignore ESG factors by any means, but we're becoming a crucial, and the committee by extension, and Dan and Debbie are becoming much more, I'd say rigorous, for lack of a better word, but much more focused on data and other factors that we can use to talk about these things and think about these issues. It's a big, big undertaking at our firm, which we're really excited about working with the committee and Dan on and Debbie on. And I will tell you, the committee's heard about this over a couple of meetings, and they're just waiting for us to actually come forward with the data. We keep promising we will have it for them next year. And then last but not least is the midterm pool, which is essentially a lower risk, less volatile pool. So you can see its returns have been lower. That's because it has more bonds in it. We'll look at the asset mix in a moment for that pool. What I want to do, though, for a second is, one of the problems with these types of numbers I'm showing you here is they're net of investment fees, which is great, but they're annualized, which means they're just the per year compound average, for lack of a better word. And it gives you a bit of it's a little bit misleading, I'd say, in the sense that it makes it look like the differences aren't that big, for example, and it also fails to account for the idea that if you actually generate good returns over longer periods of time, that's really important. So this next page gives you a good sense of what this actually looks like when you compound the returns. So the only difference between this page and the one you saw a minute ago is that these numbers are not per year. They're the cumulative return, just multiply it out. It's not really multiplication, it's compounding. It's a little different than math for those of you who are mathematically oriented. But the fact is, this is what happens to the actual dollars you have. And one of the things I'd point out to you is really, first of all, just for a second, let me go back. So if you look at the 2002 number, the 7.8 versus the 6.4, and now you look here, that's 332%, I'm rounding, versus 233. And so that seems like a much bigger deal than 7.8 versus 6.4. I think we would all agree. And that's a big issue with us, is how much time and success combine with one another to create a really powerful wealth creation, for lack of a better word, but philanthropic wealth creation effect, which is really important. The other thing is, I mentioned the CPI plus 5 and the challenges the indexes had keeping up with it. Look at the 305 for that CPI plus 5 return versus 233. That's a huge problem for those who only got the index return over this period of time. They've lost a lot of purchasing power. And yes, they can make it up, but it's hard, and you don't want to be in that position. And so the VCF long-term pool has not had that issue. It's actually added purchasing power at a time where it was hard to do that. And same thing over 15 years. Now, I remind you the 10-year numbers that you see here, just for a second, we pointed at these two arrows to show you the differences. So over the 2002 period and the 15 years, the portfolio's success outperforming its benchmarks drove an outcome that was incredibly important from a philanthropic perspective. 10 years, that's not the case. The outperformance was great. Nobody doesn't want the 146 versus the 126, but you could have outperformed, as I mentioned earlier, the 99% return that you needed for CPI plus 5 without having all the skill that the Vermont Community Foundation has executed over the years. And one more quick point on this page, if you don't mind. Actually, two. First one, look at the 3 years. I was bemoaning that before, and trust me, I spend a lot of time thinking about when we're underperforming. We don't like to underperform. We realize we're going to underperform over short periods of time. It doesn't make us happy about it because we're very focused on it for lots of reasons. One of which is, what can we be doing better is always a question that needs to be asked and gets asked constantly, both by the committee, Dan, Debbie, and ourselves. But what I'd also point out is the underperformance I showed you earlier, which is the 29.1 versus the 32.3. When you put it on this picture, you kind of get it into the right perspective, which is it's not that big a difference. And yes, you don't want to see that happen for many more years, of course, but we're willing to make the trade, and so is the foundation, between the 332 versus the 233. That matters a ton. We'll live with the 29 versus the 32. No, we don't like it because that's a good trade-off. And we need both, unfortunately, to have this outcome. We can't always outperform. It doesn't work that way. Is there a question? I'm sorry, someone trying to jump on with a question? I want to make sure. No. Last thing on this page, take a look at CPI plus 5. This is cumulative, so it's harder to see. Maybe I should go back for a second. But mine. Look at CPI plus 5 over the last year and calendar year to date. These are bigger numbers than we've seen in a while. The consumer prices are rising at a quicker pace. And one of the great debates that people are having, of course, is whether this is a very transient thing, as the Fed has wanted us to believe a few months ago, or whether there's something more permanent going on. And we're going to come back to that in a minute, if you don't mind. But let me take a quick pause here and just see if there are any questions on the portfolio's performance, either the long-term pool, the socially responsible pool, or the midterm pool. Okay. So while we're just talking, one last slide on performance, please jump in at any time with questions. But one more slide on performance, which is to look at the differences in the two pools in terms of how they perform relative to one another. It's interesting, they're cyclical. So what this graph is showing you is looking at rolling 5-year windows of time. So the other graphs I've showed you, the other tables and charts are all kind of endpoint sensitive. They go from one period to another period, and the ending period is always September of 2022. This graph doesn't do it that way. This graph says, let's look at every single 5-year period, rolling it along monthly as we go. And the blue line is the long-term pool. When it's above 0, it means it's outperforming. And in this case, we're using a simple 60-40 index. And we chose a different index because this index is about the same from a volatility perspective as the two pools, give or take. But it's also, we just wanted to pick a neutral benchmark because both pools have different benchmarks. We just wanted to use one because you only use one on this graph. But when the blue line or the orange line are above the black, you can see the portfolio is outperforming. And so one of the things that we're really excited about, you might guess, is when you look at the blue line, it's above that black line almost all the time, with the notable exception of this period on the right, which is that part I was talking about where the value bias proved to be exceptionally painful beyond anything we'd seen. And what's interesting is you look at the recovery that's occurred more recently, we still have the value bias. Value stocks haven't really done that much better than growth stocks. In fact, they're doing worse again. So my point being that this portfolio is not just about its value bias, but if it gets extreme enough, like we saw in particularly in late 2019 and early 2020, it can have an effect that we just absolutely hate. But nevertheless, that's what happened. And the recovery, I think, tells you a lot about the quality of the portfolio. The other thing you see here is the way that orange line has progressed. This is in part due to improvements that have been made to the portfolio as the portfolio, the socially responsible has gotten much, much bigger over the years. In fact, it's over $100 million today. So that gives us a lot more options. It's made it a better pool without question. It's also a bit cyclical in the sense that the socially responsible pool has a little more of a growth orientation than the long-term pool does. And so you can see that creates performance differences, particularly where that pool didn't struggle, as you can see in the 2019-2020 period to the same extent. So this is interesting from our perspective. And I only bring it up to you, and Debbie and I have covered this many times, just so everyone can see that the pools have good days and bad days, and they sometimes are different from one another. And it doesn't necessarily mean that one's better than the other per se from a return perspective. They're just different. And we expect them both to be successful, just to be clear. That's the clear objective for everybody who's on this call and who are not on this call as well. So how do we get these results is a really important part of the equation. And one of the things I'm going to disappoint you all on is that we don't have a short-term market prediction. I'm actually going to talk about inflation a little bit later, but not with the point of saying to you, well, this is what we think is going to happen, because we don't have a crystal ball. We don't know what's going to happen. And I think investing successfully is about recognizing the things you don't know, sticking to the things you can do well, and trying to just make that all work for you and understand the risks you're taking along the way. So the things that we think about are really threefold when the foundation looks at its strategy and its portfolio. First and foremost is think long-term. So back in March of 2020, when it was incredibly easy, easiest I've ever seen, in fact, to become more short-term oriented. We were shutting down the world's economies. We were all sitting in our kitchens or our living rooms, wherever we were sitting for the first time in our careers, for many of us. It's easy to get very nervous and say, oh my gosh, what's happening? And get short-term and try to make predictions. But the 2020 proved that was a very, very risky thing to do, and that you should really stand back, take the long view, and don't abandon it no matter how hard it is, which gets to the second point, which is no short-term forecasts. If we had a short-term forecast, and I'm glad we didn't, in March of 2020, trust me, it would have been bad. We would have said, oh my God, this is going to be bad for a while. We would have been sure of that, in fact, but we don't even do that. And that saved us and saved a lot of people, I think, from not being tempted to do that. And last but not least is to be diversified. Diversification is a big thing. And one of the things that's very challenging about diversification is it by definition means that you own things that are really good and really bad at the same time. And that's the big thing that people really don't like, because owning stuff that's really bad just isn't comfortable. Nobody enjoys it. Nobody likes it. I don't personally like talking to the investment committee or Dan about the investments that aren't doing so well right now. It's not fun. And it's also, you worry that it means that this is really, really bad. It means something permanently bad is happening when usually it's not. And that's the big point, which is everything is cyclical in this world. The good becomes bad, the bad becomes good if it was inherently good, just to begin with, to be clear. And that's what happens a lot. And markets are very, very weird beasts, and they can get very pessimistic for very little reason, and then get way too optimistic for very little reason. I'll quote you one of my favorite investors out there who was actually a student leader at Tiananmen Square, and he's in the United States now. And he makes this point, which I love, which he says, they get too optimistic, people get too pessimistic, and people change their minds too quickly between the two. And I think that's a really, really very wise quote from a very wise man. So here are the three pools and their strategic mixes. So these are the mixes that the committee and the board ultimately approve every year, which essentially reflect the long-term views of where this capital should be allocated in the three pools. They're reviewed every year. They're not changed every year, but that's how we do it. And keep in mind, the changes are only made consistent with what I said earlier, which is long-term thinking, no short-term forecasts. How do we take advantage of whatever opportunities the markets are giving us from a long-term perspective? So what that leads to, as you can see, is if you look at the first two columns, numerical columns, the long-term pool and the SR pool have about 60% of their money in stocks, public stocks. That's why we use the 60-40 benchmark I showed you earlier. The midterm pool has less, 47.5% in stocks, because again, it's meant to be less volatile. So it has much more in bonds than the other two pools do. The long-term pool also has it has a small allocation to hedge funds and an allocation to private assets. The SR pool also has a private asset exposure. It's smaller. It will eventually get bigger as well, but it's a newer area for that portfolio. So we don't set a target that's very high right now because it takes a long time to build a successful private assets portfolio. So the points I would make to you are just a couple quick ones. One is these are very long-term oriented strategies. That's why the long-term pool only has 20% of its money in bonds. The SR pool has 30, and that 30 will drop over time, particularly as we build out the private asset portfolio. The second thing I'd point out is if you look at the top, there's a lot of money outside the US. That's the non-US developed, the non-US emerging, and a piece of the global equities, is also outside the US. And last but not least, and I will pause if there's questions on this page, special opportunities. Those are very concentrated, very high value add strategies that we use in the long-term pool that are meant to really boost performance. And historically, they've been quite successful. And they're really, they're the strategies that only a multi-$100-million foundation can use, because the minimums are too high you can't have big amounts of money with any of these managers, but they can add a lot of value. They do things that are very different than other investors, and they really improve the diversification and the returns of the portfolio over time. I can see the socially responsible pool eventually having a special opportunity segment as well, especially now that it's grown as much as it has. So let me take a quick pause and see if there's any questions on that. Right. So I want to just spend a minute on the investment management selection process, and then we're going to get to the inflation / what's going to happen, not next, but over the next decade conversation. So the first thing is to point out is if you went back and looked at those earlier slides with all the outperformance, I didn't describe something which I wanted. The benchmarks we use for the long-term pool, the SR socially responsible pool, and the midterm pool are all market index benchmarks. So in other words, if the allocation strategy has 25% US large companies. We use the S&P 500 for 25%, and so on down the line. So it's essentially, what would we get? We just invested in index funds. And as you all know, I'm sure, from studies and from sometimes personal experience, most investors do not beat the indexes. It's less than 10% is some of the stats that are out there. So nevertheless, this foundation, I'll go back for a second just to see, this foundation has significantly outperformed its indexes over time. And these are market indexes. These are not layup indexes that anybody can beat. So how has that happened? And the answer is a few things. One is hundreds of millions of dollars to invest gives you access to people that smaller investors just don't have access to, because there are some pretty extraordinary investors out there that are not captured in these studies that get done. They're not mutual fund managers. Second thing that can happen, you get an incredibly talented investment committee and leadership team, as the foundation has. People can make really smart decisions, not just about what to own, but what to hold and what not to do. And so portfolio construction has been incredibly successful here. And then last but not least, the one thing we'll pat ourselves on the back here, crucial, is we have brought some very good manager ideas to the table over the years. And so I just want to give you a little bit of insight into how we found these managers and what we do to find them, what we do to vet them. So these 4 points really describe a bit of our process. So first thing I'd point out is we have a team of really now 18 people who spend their lives finding managers. That's what they do, and checking on the ones we have, of course. And so you have 18 people running around the world trying to find people, and unless you're not good at what you do, you'll find people, and that's what we've done over the years. And the rules that this team follows are as follows. One is returns are always accompanied by risk. So we're not looking for investments that don't have risk. We're looking for investments that have risks we understand, and risks we think we can tolerate if they occur and our clients can tolerate, and risks that we'll get compensated to take. Those are the things that you think about from a risk perspective. So we don't like people tell us, well, there's not that much risk here. Then if there's not much risk, there can't be much return. And so we have to really be thoughtful about that subject. The second thing, and this is the 18 people plus myself traveling, we used to travel around the world. We're sort of doing that again now, although now it's gotten paused again, as you might guess. But we need to know these people. We need to build up deep knowledge of them as people, because that's what they are, who they are at the end of the day. And they are bringing their perspectives, their opinions, their analysis to the table. And these are not machines. These are investors. And they're very important that we know what they're doing, and we know how they make the decisions they make, and that they're not doing things that are too complex or too expensive. Third point, operational issues. This is where we have a team of 3 people now here at the firm that basically make sure that there's no Bernie Madoffs in this portfolio, and that we don't have those kinds of issues. And the last but not least, this is the point I was trying to make before. It's a forward-looking process. The reality is that most people, finding a lot of the managers the foundation uses is very difficult. Getting access to them is very difficult. But beyond that, what people tend to struggle with the most is they hire managers or funds that have good track records. Things are cyclical. They see a bad record and then they move on to something else. And it's that process of not being forward-looking, but being backward-looking that really hurts a lot of investors. And that's one of the things I give this committee and Dan and Debbie a tremendous amount of credit for. They are very patient when things aren't working, and they've been rewarded many, many times for that, which you saw on the record, which is just to be patient. So I'm going to skip past this. This is the amongst the many things that those 17 people have to think about, write about, and talk about. I think if you guys get the slides later, you can go through this. If you have questions, let me know. So now I want to switch gears and talk about what's happening in the world right now. And to do that, I think we need to step back in time and look at the 1970s and 1980s. And by the way, this is not going to lead to inflation's about to run rampant. Buckle up. We don't really know that. Our guess is it won't, just to be clear. But let me show you this graph. So what you're looking at here are basically from 1970 to the mid 80s. The blue line is the yield on the 10-year treasury. And you can see it's hovering, it's fluctuating, between about 6% and about 14%, that was the 10-year treasury, which I think we all may or may not remember days like that, but it's certainly pretty hard to remember. I got to tell you, it's been a long time, especially with the 10-year treasury, I think down near 1.4% this morning. So again, it's barely even on the graph. It's the very bottom of the graph is where the 10-year is today. But that blue line is the 10-year treasury. The gray line is rolling inflation. So 12-month inflation, we'll move it up month by month by month over this period of time we're showing you here. And what's really interesting is really that far right-hand side of the graph. So inflation peaked, as you can see here, above 14% in 1980. Those were the beginning, those were the Volcker years. And now we can say with the certainty of looking backwards and not forwards, that was it. Inflation had been whipped, and it was whipped until at least till today, and then in a major way at least. But look at the 10-year Treasury line on the right. It didn't go down. It just stayed up there. It stayed up there really 10, 11, 12%, which I want to give you a term that we think about a lot in this firm, which is something called a real yield. And a real yield is you take the yield of a bond, the nominal yield, we call that, the 1.4 today on the 10-year Treasury, for example, and you subtract inflation from it. That's the real yield. So if you look at this graph, if the 10-year Treasury is at 12% and inflation's at 4%, real yield's 8%, 12 minus 4. If you look at today, and the 10-year Treasury, we'll do a little rounding because I can do the math easier. Let's say the 10-year is 1.5% and inflation is 5%. That's a negative 3.5% real yield. So 8% here, negative 3.5% today. So why am I showing you this graph? Other than I don't know, I think it's fun to look at. You guys may or may not agree. But the thing that's interesting about this is the bond market was just wrong here. The bond market did what people always do here, which is assumed that gray line was not going to change its behavior. Yes, it was lower, but it had done that 2 other times before. Look in the left-hand side and the middle side of the graph, and it came right back. That's what people do. It's called recency bias when you look at academic studies of behavior. And people are doing it right now with growth stocks in the US. They're doing it right now with inflation and with treasury rates, which is they can't even begin to wrap their heads around the idea that something might be really, really different that's happening right now. And we're not sure it is, but we're not sure it isn't. And I think that is the big thing that you have to think about today as an allocator, an investor, person overseeing whatever money you oversee, which is there's a good chance that the bond market's doing exactly what we're showing you here, but in reverse, where the blue and the gray lines are inverted today, and they're going to have to come back together at some point. And that's going to be painful for people, which leads to this table, which shows you over the decades, a lot of data. So I probably will not be torturing you with every number, but a lot of data. But this page looks at asset classes, investment style in the US, and then region at the bottom are stocks in different parts of the world, including the United States. And it looks at every decade from the 1930s through the last completed decade, which was 2010 to 2019. So a few things I just want to observe for you here. So one is look at the 1.8%, right-hand column, third number down, third numeric, beyond the heading. That was inflation for the last decade, 1.8% per year over that period of time. And you can see the last time it was even anything resembling a big number was 1980s. And so it's been very tame, but you all knew that already, of course. Now look at the middle section under the 2010 to 2019, 10.7 to 15.4. So you wanted to own large cap growth stocks, which we all knew as well, over this period of time. But the reality is it didn't actually matter that much if you were mostly concerned, as we are, with outperforming inflation plus 5%. Inflation plus 5% is, let's round up to 7. Every equity class in the US got you at least 7. Really simple. Great day to be an allocator. And of course, what's fascinating about that, if you think about it, put yourself back to late 2009 and think about whether you would have been optimistic or pessimistic about prices 10 years later. Most people would have been pessimistic because they'd just gotten through the great financial crisis. Things were not great by any means. And that's exactly how capital markets work, by the way. Too much pessimism at that time, too much optimism today. Now, scan over to that middle section when we've colored in yellow or gold, a little bit of an inflation pun. So inflation, 7.4% per year. So that was the last time. That was the graph I showed you earlier, which was from 1970, 1985. And this captures a piece of that era. And it's interesting now take a look at the middle section. The value stocks, 15.3, 12.3, we're okay. CPI plus 5, I'm going to come back to that in a second, is actually about 12.5%. The growth stocks, not so good, 7, 8%, 9% per year of underperformance. We'll talk about that in a minute. This is, maybe we're not suggesting that this is the next decade, but what we are suggesting is something closer to this could happen as opposed to what we've just been through. And I think if you really spend some time, and I assume these slides are available to you, take a look at the other thing, which I won't torture you with right now, is how cyclical all this is. The things that look good become bad the next decade and vice versa. It happens all over this graph. And that is the thing. And it's in direct contradiction to what I showed you earlier, which is that people don't buy that. Walking in today to anybody and saying, oh, you really should sell your Apple stock and buy a small value name, people think you're crazy. But the reality is that history suggests you probably should do that, even though you have to pick the right ones, of course. But with that said, it's just a really interesting thing. These things are cyclical. So now let's look at a more dangerous time, though. So there are times, like I mentioned, 2010, 2019, you didn't actually have to be that good or that right, but because you were fine either way. But then there are times where you need to be really, really good at this. You need to generate the kinds of premiums the foundation has generated. So now this page takes some of those asset classes, not all of them, of course, in the prior page, puts their 1970s return in the middle column. So that's very important. Now look at the right. The right column takes that number I mentioned earlier, the 7.4, adds the 5, so you get 12.4%. And what happened to the purchasing power of the dollars you had in those areas? And it's really interesting. Take a look. US large cap equities, so the S&P 500, lost 65% of its purchasing power over the course of that decade. US large growth equity, Amazon, Apple, Tesla, Microsoft, et cetera, 82% of the purchasing power was eradicated over that decade. Only small value at 42% got you where you needed to go. And everything else was pretty although it's interesting, the 10-year treasury was actually basically a better investment than some of the other investments you see at the top, which is interesting in an inflationary period. My point is that getting it wrong is not just a minor issue. It's not, go back to that, I'm not going to go back, but if you went back to that graph I showed you earlier, so, we've underperformed for 3 years, we think that's terrible. But the reality is it doesn't have any really long-term implications for the foundation. And we've obviously more than made it up over the shorter and the longer periods. But if you lose 80% of your purchasing power owning Amazon over the next 10 years, that's not something you can just recover from. That takes decades to get out of that hole. So we can never put you or future donors or the beneficiaries of your capital and your generosity at risk of this. So this is something that has to be really thought about long and hard as an existential risk. And I will tell you, personally, as a student of market history and watching people react to it, this is the perfect setup we're in right now, where people are very sure that the large dominant winners of today will remain the large dominant winners. That's how they felt in every other decade with every other group of winners at the time. And this is a very dangerous time, is what I'm trying to say. I see a question in the chat. Oh, what is the difference between a growth stock and a value? Oh, thank you. I'm sorry for skipping that part. So first of all, when we talk about this, what we mean is a growth stock. We're using the indexes to decide what that means. And so what that means, get to a real answer to that question. So growth indexes are generally comprised of companies whose earnings are growing more quickly than other companies in the market. So for example, if the average company in the market was growing at, let's say, 6% a year, its earnings, I'm making up the numbers, but the growth index would consist of companies that are growing at earnings at 10% per year. So that's what a growth index consists of. It's just faster growing businesses. Value stocks tend to be the ones that aren't growing as quickly as the index providers determine it, and they tend to be cheaper because they're not viewed as being as good. So that's the big difference. And now most people have asked the question, do you want to own a growing business or a cheap business? Most people would say, I want to own a growing business, of course. So we're going to return to that in a minute, if you don't mind, because that sounds so obvious. How could it not be true? But it's actually not true. And you can see that when you look back. You can see that when you look back here, that owning growing businesses in the 1970s and the 1960s and the 1980s, it was better to own the cheap businesses, not the growing businesses. It's fascinating thinking. And again, it's not something that people intuitively think about very much or understand. So let me go to the next slide, which is a perfect lead into this. So why would a cheap business be better than a growing business? Why would that even be possible? And the answer is pessimism and optimism again. Cheap businesses are better investments when they're too cheap, and growing businesses are better investments when they're not too expensive. And so what's happening here, so I don't want to torture you with this graph too much, but what this is looking at is the historical difference in what people are paying for that growth between value stocks, the Russell 3000, which is just US value stocks, and the Russell 3000 growth. So the blue line reflects the difference. So now, as you might guess, value stocks are always cheaper than growth stocks, and they should be. Who wouldn't want to pay? You would pay more for something that's better, clearly, right? So the 70, which is the average on this page, means that basically people pay 70 cents on the dollar for value versus growth. That's the spread that history suggests is the relationship that exists. Now, look where that blue line is today, though, which is the far right-hand side of the graph. It's down near 50 cents today. So instead of paying 70 cents for that dollar of growth, they're paying 50 cents or double inverted, right? So $2 for every dollar of growth versus the $1.50 they normally pay for it. That's the problem for the growth investor today, is you're paying a lot for the growth. And that's what leads to the chart I showed you earlier, which is it doesn't work. You don't get more, even the company's better. And I know it's a very hard concept to wrap everyone's heads around, but that's the way it works. It's not just how good something is, it's what are you paying for it that also matters, which leads to this graph where we went back and we looked at the difference between these two indexes. So the Russell 1000 is the same as the Russell 3000. I'm sorry, we had to change the index. The graph was from someone else and we had to use it. And just so you know that it's not shenanigans. We don't do shenanigans here, but Russell 1000 is the 1,000 largest companies. The Russell 3000 is the 3,000 largest companies. You might say, well, that's a big difference. And the answer is not, because every company is weighted by the size of the company. So I think Amazon and Apple are $2 trillion companies today plus. Trust me, there's a lot of small companies it takes to get to $2 trillion. They don't even matter in these indexes. But what this graph, a chart is showing, a table is showing you, is that when we look at these two indexes, you have the essentially the price appreciation, which is what did those two indexes do from 1986 to 2019. So why do we pick this time period? Because I want to be really clear that we're very, very focused on good data. The 1986 period, and that's a start date. That's because that's when Frank Russell, who provides his indexes, provides the earnings data. So they started it there. That's all we can do. The 2019 now is something that you could question me on, and I'll be able to answer your question in about 3 months, which is we purposefully excluded the pandemic from the numbers because value companies, which are more cyclical, tended to get hurt much worse in this pandemic than growth companies. You might say, oh, now here you go, you're manipulating the numbers. And I would tell you I'm not, and here's why I would say that. Because we're already seeing the back end of that. As the economies have come back, the value stocks are dramatically outperforming in terms of earnings, the growth stocks right now. So it's catching up. And we've actually decided internally that the end of 2021 will be a very good time to take a really good look because the cycle isn't complete, but it's close enough. And I don't like showing you older data, just to be clear. But we thought it was very important not to distort these numbers with the pandemic. And again, come next quarter, I'll show you the numbers. You'll decide whether or not you should have believed me this quarter or not. But basically, what's interesting about this page is look at that middle column. So growth companies did grow quicker, 7.1% per year is what their earnings growth was, 5.8% for the value index. So our problem with that is, yeah, it's better, but why would you pay double? Take this page. When that's down near 50 cents, you're being asked to pay double for a growth stock as an indexes go versus a value stock. Why would I pay double to get a lousy 1.3% more earnings growth? It makes no sense. And it doesn't have to make sense for people because they just like what's working. They don't like what's not working. That's how people are. But look at the right column, which is another thing which is kind of interesting, is that the gap on total return versus price appreciation is a lot smaller. So the Russell Growth Index had 8.9% per year of price appreciation, and the value index only 7.2. But the total returns are 10.6 and 10.3. What's the difference? The difference is dividends. Growth stocks don't tend to pay dividends the same rate as value stocks. And so this is another thing that's a great equalizer of these two over time. So my point being that here's where we're going to go with all this, if you don't mind. We're at a time where the bond market looks excessively confused, for lack of a better word. We have other phrases we use, but something seems really, really weird going on right there. And we're all aware of COVID. We're all aware of how economic conditions being challenging, but it's also not hard to paint a picture of at least moderately higher inflation going forward. And by the way, a lot of us might agree that moderately higher inflation, particularly those around wage inflation, could be actually very good for our society and probably very good for our economy ultimately. But nevertheless, it's something that could be changing as we speak. So we think about that as an issue. What do you do though when you have to deal with the fact that CPI plus 5% is the goal? And there's a section of the market that people love, the S&P and the growth stocks, that are not priced for good returns. And there's a section of the market that's priced for excellent returns, the value stocks and some of the non-US stocks. What do? And the answer is you start off by saying what I said earlier, which is don't be so sure. We don't know what's going to happen. We do not know for sure what's going to happen. We're just thinking about what might happen. And in the event that these things do happen, what can we do that has two qualities? Quality one is something that can achieve CPI plus 5, whether or not our prognostication is right or wrong. And number two is not, as I said earlier, to be too sure about anything. So that leads you to that first word or the fifth word or sixth word it is on that top bullet point, stay diversified. If you go back and look at that decades graph later, the answer isn't, oh my God, I should have been in value stocks in this decade and I should have been in growth stocks in that decade. You're never going to know that. You should be diversified. You should own both. And you should be thinking about what we're doing, which is tilting towards the area that's been the weaker of the two over time. That's what good investing looks like. It's not binary, let me dump all those small value stocks and buy just large growth stocks. It should be own both, but tilt. Again, like I said, I want to repeat that again. Tilt towards the stuff that people don't like. You're a very, very good company when you do that. Not big company, good company. Second point, don't ignore valuation. When people tell you, oh, this company's a great company because it's going to grow, you need to ask that second question. What am I paying for that growth? And it's a hard question to answer, which is why people don't ask, but it's important. And then last but not least, the foundation's long record of adding value because of the access to top investors, the fact that the foundation itself, because of all of you, is an exceptionally desirable investor for a lot of these managers. Most of the managers we're talking about in this portfolio have a choice. They don't need anyone's money. They choose who they want to have as investors. And they've chosen the Vermont Community Foundation because they really love what if they're skillful, they love what they add value and to add to what you guys are able to do in Vermont and elsewhere. So our strategy is quite simple. As you've heard it before, let me play it one more time. We stick to things that we can get right. And the things we can get right are diversification. The things we can get right are strong manager selection with a very patient approach. The things we can get right is keeping a long time horizon and not getting tempted by short-term thinking. The second point I want to reiterate again, hundreds of millions of dollars with great investment people around the table at the Vermont Community Foundation is a big, big deal. And when we can keep that together with a combination of index funds and active managers, that's how you get the outcomes we had before. And then three, I know people hate this. I've never figured out a nice way to say it, and my wife tells me I shouldn't say it at all, but we like mayhem. And we don't want anyone to suffer, and we certainly don't want any health crises, but the mayhem is good for us, and we know that. It's tough when you're going through it, but we know that that's how we got those results that you saw earlier. So let me take a pause finally there and see if there are any questions. I guess here's the quick commercial for us. I just want to point out one thing, not that it matters about us too much, other than just to say that we do focus on nonprofits, so this is all we think about all day. And the second thing is just as a reminder, we don't manage money specifically. We help clients choose managers. We don't get paid by those managers. We only get paid by the Vermont Community Foundation. We have no conflicts of interest, and we've spent a long time in this business. I'm sorry to say, or I'm not sorry, I'm happy to say I've been at Crucial now for 35 years, and my 36th anniversary is coming up in a few months, actually. Let me stop there and see if there's questions.
Anyone have a question for Mike? Feel free to jump in, or you can put it into the chat. Mike, on my limited screen, I cannot see the chat. I apologize. I'm not assisting you in any way today.
It's okay. I've
okay,
turned off
Deb,
this.
go ahead.
So Mike, this is David. I'll ask you a question.
Thanks, David.
Have I taken correctly from what you said that in the long run, you don't think inflation matters a whole lot? It's uncomfortable. It does different things with bonds, but that you are not changing a strategy on the base. You wouldn't change a strategy on the basis of predicting, were you to predict inflation?
I'm glad you asked that question, David, because that's 80% of what I wanted you to hear. So let me try to make it 100%. That last part you said is spot on, which is we are not changing the strategy because of what we think inflation might or might not be in a go-forward basis. So that's absolutely right. The part that I would say differently is that it's not that inflation doesn't matter. It does. In fact, it's central to the objective of preserving our purchasing power. So we cannot ignore it. We will not ignore it. It's important from that perspective. It's also important from our perspective when the capital markets are ignoring it, and it's not completely something that can be dismissed. So I would say it's important. At the same time, I would say that we do two things. One, we're not changing our strategy to address it as though we knew what was exactly going to happen. But two, we have thought about our strategy in terms of, well, how will it do if inflation does rise in a meaningful way, in a sustained way? What will that do to us? And if we did that analysis, we'll give you the answer. If we come to the conclusion, oh my gosh, this portfolio would be an unbelievable unmitigated disaster if inflation were, let's say, 4 to 5% per year for the next decade, we would have then made some changes likely to the strategy, not because we knew, but because we didn't like the balance. We had too much risk essentially related to inflation. We did not come to that conclusion, which is why we didn't need to make any big changes related to this. So I hope that was a little bit more of what I was trying to say, at least. So it does matter, but we don't have a forecast that we're so sure about. Thanks, David.
Thank you.
think there was another question. Does someone else have a question? Okay. Okay. Well, thank you, Mike. Very informative. I've always
Thanks.
appreciated the charts. It helps me see things what you're talking about. And let's hope that next year continues to be a strong returns and also a little bit of quietness on the other fronts that are giving us all a little concern right now.
Oh, actually, Deb, before you wrap up, someone just sent me a question directly.
Great.
Do you mind if I answer that one?
Sure.
So the question is, what investment strategies are good during inflation? That's another great question. So if you don't mind, guys, hang on for another second. I'll do my best to answer that. So there really are a few things that are good during inflation. One you will not be surprised to hear are commodities tend to be good inflationary asset classes. Now, let me use that as a really important example. We don't really own commodities in the portfolio of any significance whatsoever, if any, actually. And the reason we have some, excuse me, not that much. The reason we don't, and the reason we don't go out and say, well, let's buy commodities now because of inflation is really what I was trying to say to David before in his question, which is, I guess if we were sure that inflation was going to be very high for a while, then I guess it would make sense to buy some commodities. But we're not so sure. And commodities fail the part of the test that we care about the most, which is if there isn't much inflation, commodities are a terrible investment, and they will not help us with CPI plus 5%. So we don't like things that are one-dimensional that way. So that's just, I'm sorry for the tangent, but commodities are the go-to asset class for inflation when most people think about it. But again, if there's no inflation, you're not going to want to own those things. And forgetting all the social issues and the environmental issues related to commodities as well, and put those aside for a minute. Now, the other asset classes that tend to do well during inflationary periods, you saw it earlier, things that are somehow where the businesses, and equities is the answer to the question, by the way, but only equities where the businesses actually profit and benefit from inflation. And it's not just commodity-oriented businesses that do so. Banks tend to benefit from inflation because interest rates are higher, interest spreads are higher, and their earnings go up as a result of that. And there are a whole bunch of cyclical businesses that do benefit from inflation. So that's another area where you can get involved with things that are inflation. Another asset class tends to do well in inflation, again, if well bought and well managed, is real estate. Real estate can have inflationary components to rent rolls and other things. So there are different asset classes that do well in inflationary periods. And that's a really important part of the equation as well. So there are areas to go. And then last but not least, we would say that, so equities is the answer I'm trying to get to here, but equities in the industries and with the management teams, people running these companies that are either have businesses that do well in inflationary climates, or another aspect of this is companies that are better managed than their competitors, because mayhem in the economy is good for stronger management teams relative to weaker management teams. That's another thing we think about a lot. Another question that just came up in the chat was, can you explain the different types of assets that are held in the private assets investments? Absolutely, yes. So it consists of largely venture capital and growth equity, a little bit of more mature private equity or buyout firms, some real estate, and basically some older hard asset exposures that are really dwindling away at this point. But it's mostly venture and growth equity today. So a lot of tech, a lot of healthcare. And this has been an enormously successful part of the portfolio. In fact, I think one of the most interesting things about being an investor in today, mostly the long-term pool, but eventually soon the socially responsible pool as well, is your ability to invest in a more liquid way in illiquid assets that are kept admittedly at relatively modest levels, but you're getting the benefit of this gigantic and almost a little frightening boom going on in the venture growth equity world today. The write-ups in the portfolio are just insanely large. And by the way, just so no one's too nervous, some of them are turning into cash. They're coming back to the foundations, huge exits, huge returns. And so we're really excited. And that was definitely a contributor to the returns you've seen over the last year in the long-term pool in particular. So again, a lot of venture capital and private and growth equity.
Great. Well, those are great questions. Oh,
Mike, we've got another question.
Yeah.
Sure.
In the chat. Can you please explain what type of assets are held in the private assets investments?
Yeah, that was the one, actually. I think Stacy, I hit that one, I hope. There's more though. Yeah, that's okay. I'm sorry. I'm doing my talk too quickly thing right now. But if there's anything else people would like to ask about that, I'm happy to share more.
Okay. Great. Well, I'll start to wrap up again, but if there's another good question, we'll jump in again. But I see someone's just saying thank you. So thank you, everybody, for joining the call. Really appreciate the questions. As you can see, it definitely brings more information to share with each other. And so we appreciate you either asking or putting them through the chat. And our next meeting is, I believe, sometime in the first quarter. And I forget the date at this point, but we will send out the reminder for people to join along with the slide deck and the link for the presentation with me and Mike. And we hope you have a happy holiday season. Thank you so much, and we'll see you in 2022.